All right, welcome back. Today, we're going to peek behind the curtain of one of the world's fastest growing economies to figure out, well, how exactly it plans to pay for its future. This is a story about massive ambition, critical infrastructure, and a really unique financial machine.
I mean, think about it. How on earth do you fund a dream that's worth trillions of dollars? Specifically, how does a country like India pay for the gigantic expansion of its railway network? This is the literal lifeline of its economy. And we're talking about thousands of new kilometers of track, super fast trains, and modernizing a system that carries millions of people every single day. The scale is just mind-boggling.
Well, the answer, believe it or not, comes down to this one very special company that you might not have even heard of, the Indian Railway Finance Corporation, or iRFC for short. It's a powerhouse owned by the government, and its one and only job is to be the dedicated bank for the Indian railways. Let's dive in.
All right, so let's get into it. To really understand what makes iRFC tick, you first have to appreciate the sheer amount of money the government is pouring into its railways.
I mean, just look at that number. For the 2026-27 fiscal year, the government set its highest ever budget for the Ministry of Railways. This huge wave of spending is basically the rocket fuel for iRFC's entire business, because every rupee the government spends on new trains and tracks means more business for the company that finances it all.
Okay, so how does this machine actually work? Well, to get that, we've got to look at something kind of weird, a little paradox from their latest financial report.
In their third quarter results, iRFC's revenue actually went down a little bit. Now, usually that's not what you want to see. But here's the weird part. At the exact same time, their net profit shot up by over 10%, hitting a new record. Now, wait a minute. Revenue is down, but profit is way up? That doesn't usually happen.
Right? How is that even possible? How do you make more money when you're technically bringing less in the door? Well, the answer is hidden in their incredibly stable and really unique business model.
The secret is something called the cost-plus model. And honestly, it's genius. Picture this. You run a bank, right? But you only have one customer, the government of India. And this one customer has promised you, in a contract, that you will always make a fixed profit on every single thing you do for them, no matter what.
The whole thing works like a super simple, predictable loop. Step 1, iRFC goes out and borrows money, really cheaply. Step 2, they use that cash to buy stuff for the railways, trains, tracks, the whole shebang. And then step 3, the magic part. They lease all that stuff back to the Indian Railways on a 30-year deal. And built right into that lease is their guaranteed profit. Simple, long-term, and totally backed by the government.
So what happens when your only customer is the government, and they always pay their bills? You get this, 0.00. That's their percentage of bad loans, non-performing assets. They have literally never had a single loan go bad. That's why we call it a fortress. It's almost untouchable.
But there's a catch with being a fortress. Sure, it's super safe, but you're not exactly set up for explosive growth. And that's exactly why the company is starting to change its game plan, moving into what it's calling iFRC 2.0.
The new strategy is simple: diversification. They're taking their superpower, that ability to borrow money for cheap, and aiming it at new targets. We're talking about projects connected to the railway system, but not part of it, like ports, power plants, and logistics hubs. And they've already started. And the best part? The profit margins on these new deals are 2, even 3 times higher than their old business.
And make no mistake, this isn't some side hustle. Look at this. The company's goal is that by 2030, a massive 40% of their entire business will come from these new, diversified, higher profit areas. This is a huge shift from being a one-customer company to a broad infrastructure bank.
Okay, so let's recap. We've got this story of rock-solid stability, plus a really clear roadmap for future growth. So, what does the stock market think about all this?
Well, if you look at a key metric investors use, the price-to-earnings or PE ratio, it tells you a lot. Compare iRFC to other big government financing companies and whoa, look at that gap. Investors are willing to pay a huge premium for iRFC shares. So the big question is, why?
And the answer is sitting right there on the screen. Look at that middle column, asset quality. While other companies have to deal with the stress of bad loans, iRFC has that perfect 0% track record. The market doesn't see it as just another finance company. It sees it as something much safer, almost like a government bond, but one that could actually grow.
Okay, but it can't all be good news, right? There is one big elephant in the room.
Right now, the government owns over 86% of the company. But because of regulations, they have to sell that down to 75%. That means a big chunk of shares, about 11%, is set to hit the market sometime in the next couple of years. And that could put a temporary lid on the stock price while the market absorbs all those new shares.
All right, so let's put all the pieces together. You've got the fortress-like safety, the new launch pad for growth, and this short-term risk hanging over it. What's the final verdict here?
Well, the takeaway from the source analysis is pretty clear. It's seen as a strategic buy for anyone who wants a piece of India's logistics backbone, but with this incredible margin of safety built right into its DNA.
So, to boil it all down, the whole investment case really stands on 4 legs. You've got that ridiculously good asset quality, you've got a business model that guarantees profits, you have a smart plan for growth with iRFC 2.0, and you're riding this massive wave of government spending on infrastructure.
And that leaves us with the big question to chew on. Is iRFC a fortress of stability, offering almost unparalleled safety in a crazy world? Or is it a launch pad, ready to fire up a whole new engine of growth? The really interesting part is, it might just be both.